For decades, Methode Electronics operated as a quiet giant in the global supply chain, manufacturing the custom-engineered mechatronics that lived inside everything from construction equipment to commercial jets. By 2016, the company hit a record financial peak. They had secured a massive contract to build the tactile center consoles for General Motors, a single program that ended up accounting for nearly 50% of Methode's total net sales. But in 2020, the automotive industry rapidly turned. Car makers began stripping physical buttons out of vehicle interiors, replacing them with the integrated digital touchscreens required for modern electric vehicle architectures. Almost overnight, Methode found half of its entire revenue stream anchored to a technology that was effectively obsolete. When an industry transforms this quickly, the very product that built a manufacturer's dominance becomes the heavy anchor dragging it down. To adapt, Methode attempted a complex transition to high-voltage vehicle architectures, centralizing these manufacturing efforts at their primary facility in Monterrey, Mexico. Then the pandemic hit. The Monterrey plant suffered a severe talent drain, losing the highly skilled engineering and operating personnel required to execute a high-mix, low-volume production model. Without that core engineering expertise on the floor, the facility fractured. Product launches fell substantially behind schedule, and the company struggled to meet the exacting standards of the new electric vehicle market. This chart of the company's net income shows the impact of that failure. The operational breakdown in Monterrey drove a severe plunge, and by fiscal year 2025, Methode recorded a massive $62.6 million net loss. Overlaying the depletion of free cash flow shows how keeping legacy automotive projects on life support was actively depleting their remaining liquidity. When supply chain failures and talent shortages collide, the resulting cash burn can trigger a systemic corporate death spiral if management cannot arrest the fall. Enter CEO John DeGaynor and a new executive team. They diagnosed the core issue immediately. Methode's portfolio was dangerously bloated, stretched entirely too thin across projects that were no longer profitable. They began triage right away, finalizing an agreement to sell off their Hardwood Heights facility in Illinois and winding down their legacy appliance touch panel contracts. The cornerstone of the restructuring was exiting the non-core interface segment entirely. Their DataMate unit was divested for $16 million. This meant walking away from $18 million in revenue, but crucially eliminated $3 million in annualized operating losses. By intentionally shrinking its revenue footprint, Methode finally eliminated the cash drains that were preventing a recovery. The purpose of this triage was to rescue trapped engineering talent and resources, freeing them up to focus on high-margin opportunities in digital infrastructure. They funneled these resources into their industrial segment, specifically focusing on the massive power requirements of AI data centers. They ramped up production of laminated busbars, the critical components needed to distribute power through these massive server racks. The reallocation paid off. The industrial segment quickly achieved a $120 million annualized run rate in data center power solutions, with a growth potential of 50% from their existing customer channels. Navigating an industry-wide transformation requires cutting your losses on the technology of the past to fund the infrastructure of the future. In fourth quarter fiscal 2026, the turnaround's impact was clear. Driven by industrial growth and automotive recoveries, net sales hit $298.1 million, breaking Wall Street estimates by 25%. Free cash flow returned to positive $15.6 million, and Methode finally achieved GAAP net income profitability. In less than 2 years, Methode went from a $62 million loss to a profitable turnaround, not by expanding into new markets, but having the discipline to cut away parts of the business that were no longer built to last.